The trade does not appear on any exchange. That is the entire point. It is 7:43 a.m., and you are executing a $340 million block of a blue-chip equity for a pension fund that cannot let the market know it is selling. If the market knew, the price would move before the order was complete. The selling would create the loss it was trying to avoid. So the trade happens here, inside a system that most people in finance have heard of and almost none have seen from the inside. No ticker tape. No time and sales data streaming to a terminal somewhere. No price discovery in the public sense. Just a matched order between two institutions who needed each other and found each other inside the dock. You are 26 years old. You have been here for 8 months. You are still learning what here actually means. You came from an equities desk at a mid-tier broker. 2 years of watching order flow, building execution models, learning how institutional volume moved through lit markets and left footprints, price impact, market impact models. The way a large order, if handled carelessly on a public exchange, advertised itself to high-frequency traders who would reprice the stock before the order was half filled. You understood the problem before you understood the solution. The solution was this: a venue where large orders could find counterparties without broadcasting their existence to a market that would immediately trade against them. Your head of desk called it plumbing, the plumbing that makes the institutional market function without destroying itself. You thought that was too modest a description. After 8 months inside it, you think it might be exactly right. The pool you work in holds approximately $2 trillion in daily notional flow on active sessions. The number is not public. It appears in no regulatory filing in that form. You know it because you build a daily volume aggregation model, and you watch the output every morning before the session opens. $2 trillion of equity transactions that the public market will never see, never price, and never know occurred. The participants are sovereign wealth funds, pension allocators, insurance company asset managers, large mutual fund complexes, and the proprietary desks of 4 global banks. Nobody small is in this room. The minimum block size to access the pool is $10 million. That threshold exists to keep out everyone who would use the information asymmetry for the wrong purpose. The threshold does not eliminate information asymmetry, it concentrates it. Your job title is execution analyst. What it means in practice is that you are responsible for the matching logic on the fixed income adjacency book, a secondary venue within the pool that handles equity-linked structured products, convertible bonds, and hybrid instruments that don't fit cleanly into the equity matching engine. The instruments are complex. The counterparties are sophisticated. The stakes on a mismatched execution are significant in ways that a single number cannot capture, because the damage is not just financial, it is reputational, and in a venue that operates entirely on trust between a small number of enormous institutions, reputation is the only infrastructure that matters. You have made 2 errors in 8 months. Both were caught before settlement. Both were documented. Both are still in your file and will remain there regardless of everything that comes after. You learn the pool's architecture slowly, the way you learn a city by walking it rather than studying a map. There are 4 matching engines running simultaneously. The primary engine handles large cap equity blocks, orders above $50 million that need to cross without market impact. The secondary engine handles mid-cap flow, smaller blocks where the liquidity is thinner and the matching takes longer. The third engine is yours, the hybrid book. The fourth engine is the one nobody on your level discusses directly. It is referred to in internal documents as the Strategic Reserve Facility. You have seen its references in system logs. You have never been given access to its parameters, and no one on your level has raised the question in any meeting you have attended. You understand that asking would be the wrong move. In a system built entirely on controlled information flow, the fastest way to restrict your own access is to request something you have not been offered. You file the observation and continue building the map. 3 months in, you start noticing patterns in the aggregate flow. Not in individual orders that would cross a compliance boundary you understand precisely. Patterns in the timing of liquidity provision. Certain counterparties consistently appear on the bid side of the book in the 30 minutes before scheduled macroeconomic announcements. The positioning is not random. It is not illegal in the technical sense because dark pool participants are permitted to use publicly available information to inform their positioning. But the precision of the timing and the consistency of the pattern across multiple announcement cycles tells you something about the informational sophistication of these participants that no public data source could fully explain. You document what you observe in the compliance log as required. You do not discuss it outside the compliance function. You understand that what you are watching is the market working exactly as it is designed to work for participants who have built the infrastructure to extract maximum value from available information. You are not surprised. You are educated. By year 2, you are running the hybrid book independently. Your senior analyst moved to the strategic desk, a promotion path that tells you precisely where the institutional value of this operation sits. You manage 12 active counterparty relationships, each one required between 4 and 18 months to onboard through legal review, compliance screening, and bilateral framework negotiation before a single order crossed. Each relationship carries a signed non-disclosure agreement, a trading framework, and an execution history maintained in a secure system accessible to 4 people, including yourself. The relationships are not friendships. They are structural dependencies. Each counterparty needs the others to exist because the pool only works if the liquidity is mutual. If one major participant withdraws, the matching rate deteriorates, and the remaining participants face worse execution quality, which creates an incentive to withdraw, which is the dynamic that ends pools entirely. You are a steward of the collective incentive structure. That is what running a book inside a dark pool actually means at a level no job description has ever captured. The regulatory environment has tightened twice since you joined. 2 disclosure rules. 1. Consolidated audit trail requirement. 1 best execution guidance update that added 12 pages of documentation to every session report. You attend the compliance briefings and you read every updated framework in full. The regulatory intent is to reduce the opacity of venues like this one without eliminating them, because eliminating them would push institutional volume back onto lit exchanges, where the price impact would damage the pension funds and insurance companies holding the retirement savings of millions of people who have never heard of a dark pool and never will. The regulation is threading a needle. You work on the inside of the needle. The view from here is consistent. Regulation is always slightly behind the architecture. The architecture adapts. Regulation catches up. The architecture adapts again. That cycle has been running for 15 years. You are 31. You have been offered a position on the strategic desk. The conversation was brief, and the full terms were not discussed where the offer was made. They were discussed 3 days later with someone whose title does not appear on any internal directory you have accessed. You accept it. You do not yet know what accepting means in full. What you know is this: the pool is infrastructure. It is the plumbing beneath institutional finance, invisible to the market, essential to the market, operated by people who understand that the invisibility is not a flaw in the design. It is the design. Somewhere above you, in the lit market where prices update in milliseconds and every trade is timestamped and disclosed, a retail investor is watching a ticker and believing that what they see is the complete picture. It is not. It is the surface of a system whose depth they will never see and whose volume they will never know. You are not the cause of that asymmetry. You are the person who keeps it running cleanly. The distinction feels important. Most days you believe it is.